Hello and welcome. My name is Hamilton Lewis. I'm your host tonight for Public Affairs Public Access. And I'm inviting you today to position yourself so that you can learn, understand some principles that will aid you in preserving your capital and accumulating additional capital as the markets enter a phase that most likely many will become very disappointed with. What I want to share with you is certain principles that have been around for many, many years. These principles have been used by legends such as Mr. J.P. Morgan, Mr. Jesse Livermore, Mr. Harriman, and there have been mentors around who have studied the footprints of these large money makers, and they've documented how these people behave. And now for us to participate with them, it's appropriate for us to learn, understand, and trade in harmony with them. Because the markets go up when we think it's supposed to go down, and the markets go down when we think it's supposed to go up. So we want to use certain principles. We want to introduce science so that you can understand the science behind the methods I'll be sharing with you. I want to share with you some techniques. And I also want to share with you the art of how you can accumulate wealth regardless of what the markets will do. You know that you can make money 7 times faster when the markets fall. If you don't understand what the markets are doing, then it will be unlikely for you to make any headway. So let's consider the science that goes with the marketplace. And let's go to physics to understand how physics influences the markets. You know that the market moves. And as a result, there are laws that govern motion. We start with the principle of force equals mass times acceleration. The force is any pull or push, and that mass is the volume that is in the marketplace. So the volume happens to be an effort that influences the price to establish a result. And if you can understand this basic principle, you'll know that nothing happens by chance. There are 3 basic rules that govern motion. The first law tells us that nothing wants to change. The price wants to stay the way it is until and unless it's compelled by an outside force, at which time it begins to move in a straight line. The second law of motion tells us that the amount of displacement will be equal to the magnitude of the force impacting that. And of course, we know that acceleration is the second derivative of motion with respect to time, whereas the first derivative of motion with respect to time is velocity. So nothing moves by accident in the marketplace. Everything is precision driven. And it's necessary for you to understand these scientific principles behind the markets so that you can be aware as they happen. Looking at the next slide, we understand that there is also the trigonometric function known as the sine wave. Sine wave is incredible from the perspective that it derives its origin from the unit circle. We know that the circle has a 360-degree pattern. If you look at the bottom of the wave curve, we have a length or a period that is known as the frequency. That frequency tells us that the frequency is proportional to the amplitude of the cycle. Excellent. So if you look at the top, we start at the minus column and we go to the top. Now, as the market rises, people become very, very excited. You should become less excited when the market rises because the opportunity for upside potential is limited. But most people completely forget and they believe that the trees will grow to the sky, not knowing that the professionals are in the process of distributing the merchandise that was bought at lower prices. So if you like to hold on to these prices when you should be selling them, you say, well, I should have sold when it was $100 a share. And all of a sudden, your anxiety begins to build. You begin to deny. You begin to disbelieve it. You become very fearful. And you wonder, wow, perhaps I should just forget about this opportunity because it's obviously not for me. But there is a specific cycle involved that you need to pay attention to. And of course, if any of you have any questions out there that you want to throw in or ask me, please feel free to do so. So notice at the bottom of the market, the news is very ugly. The bears have come into the arena. They're ruling the show. And before you know it, you throw in the towel and the market takes off and rallies. So if you look at the next slide, you have an opportunity to pay some attention to some principles. You want to know when the buyers are active and when the sellers are active. We all know that in the buyer's market, prices fall. And in the seller's market, prices rise. So let's use an example. If you want to buy a home, or any asset for that matter, you would want to get the lowest price possible. You always like sale. All of us like a deal. So you want to make certain that, remember this principle, in the buyer's market, prices fall. And in the seller's market, prices rise. And it's the same thing in the stock market. So if in the buyer's market prices fall, why would you want to sell when prices are falling? And if in the seller's market prices rise, why would you want to buy when prices are rising? So we look at the next picture, and we understand that these principles have been around for a long time. So much so that going back to the early 1600s, the first experience was that of tulips. You needed to have a blue tulip or a yellow tulip, and if you didn't have a purple tulip, you were no one of significance. So the people watched the prices rallied from $50 for tulip buds to $100 to $200, and before you know it, people were selling, cashing everything in to buy tulips, and look what happened. The price rallied from below 100 to over 100 and just crashed. So there is really nothing new under the sun. The market keeps doing this same thing over and over again. It rallies, people get excited, they jump in to buy when it should be selling. Looking at the next slide, we have an opportunity to look at these three reliable principles that are embedded in the marketplace. The first one happens to be volume, and of course, supply and demand. Now you might think that you've heard supply and demand and you fully understand what it is. After I decode these methods to you, these principles to you, you will have a totally different idea of how they really work. So let's look at the next slide and show you how these demand and supply principles work. So I want you to learn them. Grab a sheet of paper, take your notes down, really understand it. Apply these three principles that will help you overcome your emotion. And if you're able to overcome your emotions, you can profit 7 times faster during the next market reaction. And we all know that trees never grow to the sky. If the market is rallying right now, you can be certain it's going to go into a reactionary phase. And if your 401k, your IRA is at risk, you better be protected by knowing what to do. And I'm going to show you precisely from the presentation today how you can position yourself by watching when these professionals send you a FedEx letter. And I'll tell you how to read the letter and how to respond to it. The next one would be ideal for us to look at now. So what is really volume? Volume is the number of shares or number of contracts that trades every single day in stock markets, commodity markets, and currency markets. A lot of people say, well, currencies don't have a lot of volume. There is no way we can get volume. Well, keep in mind that over $4 trillion a day trades in the currency market. And most of the transactions take place between banks. They don't want you to know what's going on, because if you know what's going on, then you can trade alongside with them. Volume also represents professional effort. Now, the effort can be low, very low, average, above average, high, and very, very high. So your takeaway from this presentation is I want you to remember very, very high volume. Every time the volume is very, very high, it will be akin to the professional sending you a telegram or a telex or a FedEx letter, because 80 to 90% of all the transactions that trades every single day on all the exchanges our professional activity or professional interests. Therefore, if you can understand what they're doing, you can be privy to their initiatives, their campaign. And so now I'm going to tell you what a campaign is. There are basically two campaigns. The campaign number one is that of accumulation. You notice it is in green. That is when they begin to buy. Prices will be very, very low. They will buy and they will frighten the daylights out of you to the extent that you will be so frightened you will want to throw in the towel. A couple of examples that relates to this is a couple of years ago, remember BP, British Petroleum, they had the oil falling in the well in the Gulf, and we were told that BP was going to be bought out, and gee, the entire fishery business is going to go out. But guess what happened? BP dropped to $25 a share, and if you'd understood this principle, it rallied to 50, so you made 100% on your money. The next campaign that the professionals engage in is that of distribution. Now, distribution, when you hear the word distribution, think of a distributor, someone who buys wholesale and sells retail. If they buy it wholesale, you know they're paying a cheap or lower price for it. And once they get their inventory levels complete, they will then rally the price, get you fully excited, get you ready to come into play, and the minute you put your hard-earned dollar on the table, they pull the rug from under you. So the two campaigns that the professionals engage in are accumulation and distribution. And all you need to remember is the very, very, very high volume that takes place. It will be akin to them sending you a FedEx letter. And once you get the FedEx letter, you will know exactly what to do. And as we proceed, you will understand that volume happens to be the effort. It is the effort, the mass, as we saw from the physics equation, that propels the market forward. It is the price is the result of that effort. So if we have a large volume, a very, very large volume, we would expect a very high effort. At the same time, a very high result, that is. Now, if the following day we do not get the corresponding action we expect, then we know that all the activity on the previous day's action was the opposite. So the laws of physics tells us that if we expect an outcome and we do not get that outcome, it means we're not going to get the outcome. We'll have to wait for another period. So moving along, we will look at volume. Over 100 years ago, Mr. Wyckoff educated us about what volume is. Very simply put, bullish volume is increasing volume, but not excessive, on rising prices. And bullish volume is also lower prices, but the volume is less. That would be akin to diminishing supply. So if the market is falling and the professionals are not selling, again, we go to physics, it tells us that they must be buying. In other words, they're sending you a telegram. So again, bullish volume is increasing volume on rallies and decreasing volume on reactions. So if you understand bullish volume, you also need to understand and memorize what bearish volume is. Bearish volume is increasing volume on reaction and decreasing volume on rallies. Let me give you an example. There are times when the professionals have distributed their inventory, and because they have the ability to see both sides of the marketplace, they will want to attract more people. They might put some good news out in the media for you to pay attention to, and all of a sudden the prices will rally. Now, as the price rallies, the volume is not there to support it. And then you can take your note card and say, wow, whenever we have rising prices and volume diminishes, it tells us that the professionals are not interested in higher prices. If they're not interested in higher prices, it automatically implies they're interested in lower prices. And if they're interested in lower prices, then you should be ready to protect your hard-earned asset that you've gained value in at the top of the market, position that, and start to sell the market short. Because you can bet your bottom dollar it will decline. A classic example is the Enron Corporation. Enron went from $26 a share all the way to $80 a share. And at $80 a share, people became very excited. They said it's going to 200. When it dropped to 70, volume began to diminish, and people are still buying. But if you understood these principles, you would know that declining prices on declining volume is not as ugly as declining prices on high volume, which is what we saw with the Enron scenario. So the next slide tells us that supply comes into the marketplace when supply enters the market, prices must be very, very high. Volume must be good. There must be euphoria. You saw it in the tulip slide. You saw it in the sine wave curve. You saw it in the excitement, the enthusiasm. People get very, very excited. They think, I must own this item because if I don't own it, I will miss out. One of the critical elements that people always fear, the fear of missing out on things. But guess what? There will be another train leaving Grand Central, so you can always get the next train. It is not necessary for you to chase the market. Let the market come to you. So when supply comes to the marketplace, the good news will be everywhere. If you go back to 1989 and you read the headlines from 1989, there was one country in the world that was the best country since sliced bread. The market was at 39,000. At 39,000, how much more can we go? Well, guess what? The market in that particular country, it's the third largest economy in the world today, went from 39,000 to 11,000 and still declining. That's what you call deflation. So there is a message of inflation and deflation, all of which are telegraphed to you by the marketplace. And if you understand these principles, you will have a classic example. Now the next slide shows us how supply really works. Remember, your key is to look for the highest volume ever. So on the chart you're looking at, the bottom portion of the chart represents the volume bars. It represents the number of contracts that trades. The top of the bar represents the result of the effort expressed by the volume to let you know that the professionals are very active. The news is very good. This is the first of the year, 2001. Conditions are good. We're going to have a great 2001. But what is the message from the professionals? From the day the market opens, they begin to sell. And so if you look to your left, you see that the bar on January 3rd is the highest volume bar. You can see the red arrow on top of that bar. So the professionals were telling you, we are selling. And what you should also do is pay attention to that, because if you held on, you would be very disappointed. The next slide shows us that if you acted on the message, you notice that the prices continue to decline. So in other words, they distributed the price, and prices just went down and down and down all the way into March 2001. Now, at the bottom of the market, the news, of course, was very ugly. The news was very ugly. The next slide takes us into March, where we see that after the distribution has taken place, the market goes into a markdown phase. The markdown phase is when they just panic everyone. People panic. And they say, you know what? This business of stock market or foreign currency trading or commodity trading is just no way to make a living. Of course, it is one of the hardest way to make a living. I liken it to chasing the wind. You have to catch the wind, position the wind, and make some things happen. Now, the next slide takes us into March. If you look at the market, went from a high in January to a low in March 2001. As the market reached its low in 2001, a lot of people were no longer interested in the market. Well, guess what? That was the campaign of accumulation taking place. So the professionals had then accumulated a lot of stock in late 2000. They distributed the stock in early 2001, and the prices were driven down into March 2001. The next slide will show you that picture very closely. Again, all you have to look for is the highest volume on the bottom of the chart. If you look at the next slide very closely at the bottom, you will see we're in March. You see that volume, how the increasing volume as the prices declines? That is a bullish phenomenon. So in other words, you don't really need to read so many documentations. You can just pay attention to the message that the professionals are sending you, because they're sending you a real-time active telegram for you to take action on. And if you know how to read the market, it changes your life forever. Imagine over $90 billion every day on Wall Street trades, over $4 trillion in the currency market. It's for the taking. If you have questions, you have your money on the table, you wonder if the market is going to go to 15,000 or 13,000, if you believe trees grow to the sky, let's have a conversation as we look at the professionals getting into the demand phase of their campaign, which is the next slide coming right up. So here we have demand. To stop a down move, demand must overcome supply. So to stop an up move, supply enters the market where the professionals begin to distribute. When demand enters the market, prices will be falling. And you might wonder, the news will be bleak. The telegram is telling you we're buying, but everything you read is ugly and bleak. And if you look at the picture of the marketplace, you notice the volume begins to increase. Look closely at the bottom of that chart. The highest volume you see, which corresponds to the lowest price, occurred in middle March 2001. So we saw supply in early January 2001, and right in March, we saw demand come into the marketplace. So now that we've had the privilege of seeing supply and demand, we're going to show you two different examples in the same year. And of course, we know what happened in September 2001. The question is it possible that someone could have known? Because the accumulation campaign that took place on March 22nd, 2001 was very, very powerful. The market went from 11,000 to just about 9,000. Then they took it again from 9,000 all the way up to 11,200 into May 2001. Imagine that. If you understand how to read the telegram that they're sending you, you'll be very, very prosperous. Of course, it's like becoming a concert pianist. It's like learning how to read sheet music. It's like learning a new language. You're obviously not going to go to Carnegie Hall by just taking one session. You have to practice and know these principles by heart, because if you do, you will be very successful. So looking at the picture in May 2001, we noticed that the news was good. If you remember, or you can go into your Google search and type in May 16th, 2001. What was the major headlines then? There was concern that the economy was going into a recession. They wanted Mr. Greenspan to cut the interest rates. And going into the 16th of May, the question was, would he cut a quarter point or would he cut a half a point? Well, guess what? He cut the interest rates by half a point. The market rallied by over 400 points. Now look what happened. We had a very wide range bar and the volume was very, very high. Look to your left. You see that the May 16 bar is the highest volume on that chart. You go on to May 18th, and you notice the market went higher, but the volume was not there. So by definition, bearish volume is increasing prices, and there is no energy or no support or no force or no activity or no intention to support that. So you would have taken your position and say, you know what, I believe the market is ready to go down because the professionals have sent you a private telegram. And this telegram alerts you to what to do. Now, look at 12,000. The market went from over 12,000, it continued to drop. May decline, June decline, August decline, and all of a sudden, we get an unfortunate terrorist attack in our country, and the market was closed. If you look at the bottom of the chart, you see that there was no action, no trading at all. But all of a sudden, just when we're told that we're under attack, the professional said, did you know that Christmas came in September? Look at the volume, the highest volume corresponding to the largest bar on the chart. This tells you that the professionals bought everything they could. They mortgaged their homes, they loaded up, and they took the market from an all-time low of 9,800 all the way into 2007. And you might recall, for those of you who saw the picture, this tells us very succinctly what the market did. The market is a language. It speaks to you. It's telling you a story, day by day, bar by bar, tick by tick. You notice in January they told you to sell. All you had to do was be like a good little soldier and sell. In March, they told you to buy. And then in May, they told you to sell the inventory you bought in March. And right in the middle of May, once they had the very good news, 400-point rally in the marketplace, they told you the inventory we had now is complete. We're now ready to unload. So as the little people were happy buying, they were dumping on them. So here is your opportunity to pay close attention, because the difference between you becoming rich or going broke lies within your ability or your inability to correctly predict the future trend. And the future trend is sent to you every single day. It's up to you to pay attention to it and make some things happen for yourself. So I want to thank you for tuning in. I want to thank you for listening. I want to thank you for taking notes. I want to hear from you. You have questions, I have some answers that will help you, your household, and your family. Because money is very critical to the capitalistic system. And if you understand how the money system works, then you can position yourself and make some good things happen. You must consume a little bit of what you earn, save a little bit of what you earn, and invest a little bit of what you earn. Some people tell you, spend more to save less, or spend more to save more. Remember, you want to save your money, you want to invest your money, and you want to understand the messages that the professionals send you so you can trade alongside with them. So, let's look at some phases of the market. Where are we today in 2012? Some of my research that I've shared with you in the past, for example, on June 13th? June 13th. We have a caller with a question. Hello?
Politically, the news is very bad right now. The Republicans are saying everything is terrible, and yet the market seems to be going up.
Okay.
Does that appear to you that that's what's happening now?
That's a very good observation. Is that all that you want to ask? I want to hang up and answer that question for you.
Okay, go ahead.
Okay.
Hang up. I'll hang up.
Okay. Remember, we said that when the markets are rising, the professionals are selling. So if the markets are rising right now, and the Republicans or the Democrats are giving you a certain message, I invite you to pay less attention to the message you receive from the politicians. I invite you to pay more attention to the messages you get directly from the marketplace. Your goal is to pay attention to the volume that moves the price higher. So anytime we have excessive volume in the marketplace, it is a direct message from the professionals to you that they're ready to take the markets lower. So ignore the news. Pay attention to one news only, the news of the market. I often say you have two friends on Wall Street, in the currency markets and the commodity markets. There are the price and the volume. And the volume happens to be the most important of the two friends. So the news might appear ugly, but pay attention to the volume, because the volume will tell you when they're going to trade in the opposite direction. And until you understand volume, you will be totally in left field, because a lot of your programs today are using price or derivative of price to determine where the market is going to go. And if you understand the real deal, you're better off going with the real deal than a derivative of the real deal. So I'd like to thank you for your question, and please have more coming. So let's go back to where are we today? 2012, March, we're in February, we have March coming. We saw what happened in March 2001. Is it possible that we could have a replay of 2001 in 2012? Is it possible that the market could rally, invite a lot of people to buy, and once you've bought, you'll be left with the empty bag as the market goes down? And then once the market goes down, we also have elections coming. We also know that during an election year, the politicians like to engineer whatever is necessary to propel prices upward so that the party that's going to win wins. So let's take another question. Hello and welcome. Thanks for calling.
Yes. I have a question.
Yes.
What should a day trader do if...
Okay, let me hang up and answer that question for you.
Thank you.
You're welcome. The question is, what should a day trader do? A day trader is under tremendous pressure to produce results. Now, it is appropriate that the day trader must understand the price and volume message. It's appropriate to understand when the accumulation phase has taken place and the distribution phase has taken place, so that you can trade accordingly in harmony with the professional interests. This is when the volume becomes extremely critical to you. Because if you're trading on the 5-minute or 15-minute or 1 minute or half a minute basis, you want to know what the multiple time frames are telling you. And if you can position yourself accordingly, you will be very successful. But again, it takes practice. You need to understand what the message is and what to do when you get that message. So day trading is substantially more challenging than end of day trading, but you can do it. It's been done before. So let's take the next call. Hello and thanks for calling. Okay, so we had two questions about the first one being news is bad, markets rallying, who should we believe? And the other question is about day trading. So I was saying, is it possible that we could have a repeat of 2001 in this year's market? Is it possible that the market will go to 13,000, 14,000, 15,000, even 20,000 as we've heard? Again, the volume will tell us. If you want to become a very good student, you study the sine wave principle, and you'll be able to identify exactly when the market will make a high and when it will make a low. Because the trigonometric function is designed for you to understand the study of angles. And by understanding when these angles, going from 0 degrees to 30 degrees, 45 degrees, 90 degrees, 180 degrees, 270 degrees, you know exactly where you are in the plane. I always liken the control tower and the airplane. Once the airplane gets airborne, the pilot knows the control tower knows where the airplane is going to be at all times. So again, the principle has been the same. We're told that second by second, moment by moment, transaction by transaction, the market sends you a telegraph. It tells you its next direction. And therefore, your best bet of understanding markets is to get all the clues from the market itself. Now, we as humans, we tend to filter what we hear. we filter what we see, we filter what we feel. The markets will give you the raw data. It's up to you to filter the message from the market and take the appropriate action. So on that note, please prepare yourself for 2012, 2013, 2014, because if the market can drop 2,000 to 3,000 points, if the markets can drop over 44% as we saw in 2008, they can do it again. Let's take this call. Hello, and thanks for calling.
I'm sorry. I got a bad line.
Yes, please turn your TV down. Hello? A bad line. Okay, so we're in a position of preparation. We want to prepare for what's coming. And we will know what is coming by the messages the professionals send us. They send us the message by the quantity and the extent of the volume that trades. Every time we have excessive volume in the market and the prices rise, it tells us that the trend is about to change. And you will understand that if the prices rise and the volume does not rise correspondingly, then we can anticipate distribution or reversal action. But if you do these simple elements, understanding supply, understanding demand, knowing when demand enters the market, when supply enters the market, you'll be very well positioned for what's coming, because it will come. Let's take this call. Hello, and thanks for calling.
I remember you from times past when you actually predicted the crash of 2008, or I guess it was, maybe late 7. And I wondered, could you tell me how you determined that and why you were so correct?
Thank you for the kind words. I'll hang up and answer that question for you. The gentleman talked about previous presentations I've had on this program. Specifically, it was June 13th, 2007, when I said the market would decline after July 2004. He remembered that we mentioned the study of cycles, and we showed the sine wave. The sine wave is a derivative of a cycle. It's derived from the cycle. So if you can understand where you are from the 0-degree plane, you can tell where the market is and where the market is going. So you can tell at the bottom there, we start on the left-hand side, we start to rally, the market goes up, and it goes up, and it goes up, and you say, wow, we're approaching maximum amplitude. Once we get to the maximum amplitude zone, you know that the next phase has to be down. So we have the same scenario developing again. And so that's what I use. I use cycles, and I use supply and demand principles, volume principles to help determine where the market is. So never believe trees grow to the sky. I've never seen any. Hope that answers your question. Let's take the next call. Hello, and thanks for calling. Okay. So the cycles are your best friend. I learned that the cycles are the mysterious elements that triggers events in our lives, in the marketplace, and every place else. And that tells us where we should be and where we should not be at the right time. So when the markets are about to collapse, it's appropriate for you to take the right action so you can position yourself to protect what you have. And by protecting what you have, you're able to guarantee your future and make some incredible things happen for yourself. So learn, practice, study, make yourself approved to be worthy of your success, because you can do it. After all, we live in America. This is a country where big things can happen if you prepare yourself. Of course, it's not easy. You have to work, you have to study, and it's a day-to-day event. The person who called about day trading, if you're trading 5 minutes or 15 minutes, you have to be on the ball every 15 minutes. You need to be able to determine what is going on. So let's take this call. Hello, and thanks for calling.
What book
would you recommend to learn your system, or your what the system that you use to understand the market?
Okay, thanks. I'll hang up and I'll give you the answer. The best book for you to read is for you to read The Message of the Market. The message of the market is expressed to you by price and volume. So we've given you some key definitions so you can understand what volume is. Volume is the most important thing in the marketplace. It tells you when the big money is having a lot of fun and when the big money is withdrawing their interest. So just as I am a student of volume, you need to become a student of volume and price, because those are your only two giveaways. The professionals leave footprints, and these footprints telegraph what they're going to do. Hope that answers your question. Let's take the next call. Hello, and thanks for calling.
My question is, if I'm not able to follow the charts and the ups and downs and so forth, what is the best way, or to whom should I give my decision-making to? What is the best way to handle this with somebody else?
Okay, thanks. I'll answer that question in a second here. The question was, if the lady is unable to follow the ups and downs in the marketplace, who should she rely on? Obviously, anyone who is capable of reading the message of the professionals is one you should find. So we understand that people trade mutual funds, and we learned that over 85% of the mutual funds underperform the S&P 500. And these are people with PhDs, people who've had many, many studies at Harvard, at UPenn, and at all these fancy schools, but yet they don't understand it. And you say, wow. So it's up to you to start doing research to find out who is a student of the market, who understands price, who understands volume, who can tell you what bullish volume is, what bearish volume is, and that will give you your initial elements to find someone to help you. So in short, you want to find someone who can interpret the market for you. The market is a story. It's telling you what's going on every second. And the long and short is you're your best bet, you're your best analyst. And it's not very difficult. All you have to do is you can decide to look once a day, or you can decide to look once a week, or perhaps once a month. Of course, if you look once a month, you could be missing a lot. So let's summarize as we go for the day. I want to thank you for tuning in. We've covered three elements: supply, demand, and we've covered volume. We've noted that volume is the most important element in your trading process. It's the most important element in your wealth accumulation process. You need to understand when volume is bullish. You need to understand when volume is bearish. Again, bullish volume is increase in volume on rallies and decrease in volume on reactions. Of course, it should not be excessive, because if volume is excessive, it will telegraph to you that the professionals are selling. And if the professionals are selling, you do not want to be buying. You sell alongside with them. Let's take this call. Hello, and thanks for calling.
Oh, hi. Can you tell us where we are on the sine wave now?
Very good. I'll hang up and tell you where we are.
Thank you.
Okay. The lady wants to know where we are on the sine wave. We're at the point of maximum euphoria right now. We understand the market is going to go higher and higher and higher. And of course, we know that as the market rises, we have to pay close attention to the volume. Because the minute we start to get excessive volume, we know that the professional is telling us something. So we are approaching very high excitement, very high enthusiasm zone, and we know that since trees do not go to the sky, it's very probable we will have a reaction. I would say that we have entered a deflationary, depressionary phase in the world. You've noticed that prices or your dollar is not giving you much when you go to the grocery store. So that's the first message. I remember when I first came to this country, you could get a stamp for 5 cents or 10 cents, and now it's 45 or 46 cents to get a stamp. That's telling you something. It's not that prices have gone up, it's mean that there has been a devaluation of your currency. So in short, we are at the top of the curve, or very close to the top, and the more the news becomes exciting, the more you want to pay attention to volume. Your clue will be excessive volume. Excessive volume is your ticket to take the opposite action. Let's take this call. Hello, and thanks for calling.
Yes, I wanted to ask about how do you feel about annuities?
Okay, let me hang up and answer that question for you. The question is, how do I feel about annuities? I'm basically neutral. Annuity is just an instrument offered by an insurance company. It's a CD. Normally CDs are issued by banks, and of course my definition for CDs is certain death, C for certain, D for death, because you have no ability to cope with the rising cost of living. So I encourage you to grow your money so that you can go to the grocery store and buy the goods and services necessary to satisfy your lifestyle or your happiness or your utility. If you limit yourself to a fixed rate of return, then the chances of you enjoying the goods and benefits of life are very limited. So I prefer going for the gold. I prefer to go for the stars. I prefer to go for the moon. And therefore, of course, that's me. But if you prefer to walk or crawl, then study the principles and take the appropriate action. Now, we've studied volume. Volume is your key. Volume is like the gasoline in your automobile. If you have a lot of gasoline, you can cover a lot of ground. If you have limited gasoline, you can cover very little ground. In addition to volume, we've studied supply. Supply is such that volume is extremely high. The news is very, very good. New products are coming to market. Imagine, markets do not move because of new products. When you go to college, they tell you that prices go up because the companies make earnings. Well, I can assure you that there is one company out there that everyone knows. It's called General Electric. In 1999, General Electric sold for $120 a share. They split 2-for-1 to become $60 a share. And even though it was the bluest of the bluest, it dropped to $4. So imagine that. If you bought it, you put $60,000 on the table, and your $60,000 turned into $4,000. And that's just one of many. There are a gazillion instances out there when you've been told something was going to happen, and it didn't happen. The opposite took place. Well, you can know when the opposite is going to take place by following the footprints of these professional people, because they tell you precisely when they're going to move. They tell you when to tune into the TV. They tell you that this gentleman is going to make an announcement at a certain time, and you need to be in there. But is it possible that someone could know what announcement was being said? You better believe they do. There are no secrets on the street. The secrets are embedded in the price, embedded in the volume. I say it over again because it's so simple. People are looking for the Holy Grail. They're looking for the black box system. But you have to do some thinking. You have to think. You have to interpret. What is the message now? Why are the professionals very active? Why are the professionals not active at this time? What is happening in Europe? What is happening in Japan? What is happening in China? And how is that impacting the price? All of these elements give you clues, but your bottom line is, once that volume becomes excessive on the high side of the market and the prices are going up, 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 like you saw with the tulips, If you miss it at $50, by golly, you better get in at 200 because it's going to 400. Really? No. It's going lower. They told us the same thing about oil in 2008, that oil was going to $200 a barrel after it went to 47. Some very brilliant people. Guess what? Oil went to $34 a barrel. Really? You can see the chart. You miss it at 50, you missed it at 100, you missed it at 200. You say, oh my God, I am missing out. I better get on board. And as soon as you get on board, the news is so good, and you go down. So it's imperative for you to understand supply. We're in a phase now where the market is being distributed. The market is being sold. The distributor are selling to the retailers. And the retailers have no other tools to use except for their friendly magazines, their newscasts, their famous TV personalities that tell them to hold on for the long term. The question is, the professionals do not hold on for the long term. What makes you want to hold on for the long term? The professionals tell you when they're selling. Why would you want to buy when the professionals are selling? The professionals tell you when they're buying. Why would you want to sell when they're buying? It's counterintuitive a little bit, but if you pay attention to what they're doing, you start to think like a professional guy on Wall Street, a professional guy who trades the market. And most of these people are in closets. You don't see them, they don't advertise, but they're quietly doing their event. You know, Mr. Jesse Livermore said you need quiet, you need to concentrate. It's a game of knowledge, it's a game of intense concentration, but it's very rewarding when you can read the messages that they send to you. You will know what's going on. And once you know what's going on, I think, or I guess you might cancel some of your subscriptions to magazines you read, because remember, we filter information. The person who's reading the story to you is filtering that story. But if you learn to read the magazine, the message that the market sends you, you will be super successful. So you need to understand, life is simple. We tend to complicate it. Markets are simple. It's just price and volume. The professionals are telling us what to do, when to do it. All we have to do is trade with them, be in harmony with them. If we do that, no telling. The next time we communicate, you will say, wow, I paid attention, I understood, I applied it. When I saw that very high volume, the news was off the charts, everyone was excited, markets were going to 10,000 plus, and guess what? I sold. It was scary because you're going to be alone. People are going to say, you want to buy? You want to sell? A classic case in point was 2005. You recall the housing markets were going. I mean, all you had to do was show up and you get a house. Real estate never goes down in value, really. Okay, well, look at the price of copper. The price of copper is telling you what's going on in the real estate market, because for every home that's built, so much copper goes into that home. And the copper market is your clue to what's going on in the real estate market. Guess what? Prices oscillate. They oscillate in a wave formation, very common to that of the sine wave curve. Google on your computer, study the sine wave, study cycles, study the charts, study price, study volume, and position yourself so that when the markets are dropping, you don't panic. You can position yourself and succeed. I'd like to really thank you for tuning in today. I think you've walked away with some key components that have been nuggets, but really not nuggets, because they've been around since the early 1600s. If you're going to do anything, you may as well learn to do it well from scratch. So learn how these guys work. Learn to understand the message to send you. And once you get the message, trade accordingly. And once you do that, you will be very happy because your success is in your hands 7 times faster when the markets decline. When the market's going up, everyone's a guru. How about when the market's going down? It's interesting we're having this discussion today as we're approaching the top of the sine wave curve, just as we were back in 2007, just as we were in May 2011. Interesting occurrence that you have the privilege to position yourself to protect your capital and do the right things for yourself, your 401k, your IRA, because at the end of the day, it's you and you and you. So let the markets speak to you, read the markets, understand the markets, and celebrate the message that they send to you. Because no one will give you the message like they will, capital they. They're the one who control over 80 to 90% of all the money on the floor of the exchange. They're faceless, they're nameless, but they're telling you something. If you'll listen to them, you will succeed, you will prosper. If you elect to go contrary to what they tell you, then you're probably going to be not very happy. So again, volume, volume, volume. Like to say in real estate, location, location, location. Here it's volume, volume, volume. If the market is going up and there is no volume, become suspicious. If the market is dropping, if there is no volume, become excited. I'd like to encourage you to study. Practice. Recite these phrases to yourself. Learn what bullish volume is. Learn what bearish volume is. Learn when demand is coming into the marketplace. And accordingly, you will prosper and you'll be ready for the next market turn because it's coming and you better be ready. I'd like to thank you for tuning in.